Hello everyone on YouTube and everyone who is enjoying this free day trading course. This is Victor from TradePro Academy, and today we are going through lesson 4 of the free day trading course here on YouTube. And
Hello
we
everyone
are
on
going to
YouTube.
talk about order flow trading today. So if you guys want to know more about order flow trading, just hit that link down below. We have a free order flow trading course. It's way more extensive than what we're going to go through today. Today we're just going to incorporate the order flow with whatever we've learned in the previous 3 lessons. So if you guys haven't seen those, check those out. They're on our channel. Last week we went through market structure trading, which was very comprehensive and a longer lesson, but there's a lot to learn there. So without further ado, let's go ahead and get started with this free order flow trading lesson. So lesson 4 today, guys. In today's agenda, we're going to be talking about the order flow introduction naturally. What is order flow? Inventory and the DOM, very important aspects, as before we had this many charts and this many tools, late 90s, even early 2000s, inventory and the DOM were how prop traders really made their money. So it's a really important aspect to understand when day trading, especially day trading futures. We're going to talk about the footprint as well. I know it's a fancy tool that a lot of people love to see but don't really understand. So we're going to break it down a lot for you guys today. And we're going to talk about execution, entries, and exits based on order flow. So what is order flow to start? It's the most raw form of data any trader has. It actually tells you market buying and selling and interest as well. Market buying interest, market selling interest. It incorporates all that raw form of data and presents it to you in a very fascinating way on the footprint and the DOM. So it used to be mainly on the DOM, and still there's a large portion on the DOM which identifies the actual interest of buying and selling. I know a lot of scalpers out there, especially in the futures world, really love just DOM trading, identifying huge levels of inventory and scalping for a few ticks, which could be very profitable, but a little more stressful. Nothing to take away from that. That's still a great tool to have and an amazing understanding no matter what kind of futures trading you do. But now it's available on the footprint. The footprint actually identifies a lot more of information that we're going to look at. So the intent of buyers and sellers does move the market. A market is like an auction, and order flow exposes all that data. Now, when it comes to inventory and the DOM, inventory is the intent of buyers and sellers on a per contract basis. So inventory and the DOM both represent where buyers and sellers are sitting to get in on the market. So again, if there's buyers below or strong sellers above, it could be a little more balanced. But if there's really strong buyers below, a decent amount below that market price, you will see price attraction into that interest to see what these buyers are made of. Now, they move the market. That's how markets move. Simple enough. If there are more buyers than sellers, the market will go up, and more sellers than buyers, the market will go down. A lot of people may have heard this in the trading room a few times, which is kind of annoying. Why did the market go up? Why did it go down? Well, more buyers than sellers, more sellers than buyers, but that's the reality of it all. We don't really necessarily need to know exactly what caused this market movement, rather how to take advantage of it, and that's what we do with inventory and the DOM. So when we introduce a price ladder, this is what a price ladder looks like on oil. In the middle is the actual price of the asset. So down the middle in the gray, this is oil. Not current price naturally, but pretty close actually. So this is the current. This is the oil price right down the middle, and then on the left-hand side we have highlighted in blue right here below at and below the market price. We have a lineup of buyers bidding to buy the market. So right here, if you put in a contract at these 53.32s and you add to this level right here, this 11 becomes 12. That is your intent to buy at that market price. Let me just on the right hand side in the red right here, from the current market price and upward, we have a lineup of sellers offering to sell at these levels. So again, if we grab this level 53.43 right here, has 15 offers sitting there. If you add 2 contracts to sell at that level, that becomes 17. Pretty simple in those regards. Every tick is a new auction, and each tick is 1 cent of price per barrel of crude. So every tick right here, one, two, three ticks of price action is a new auction. And everything on the DOM is the same for all assets. So tick by tick data, and also the inventory on either the bid side or the offer side. This is what a DOM on Sierra charts looks like. Different DOMs might look different, but we like these color schemes personally. Some people might identify with bids as being green maybe, and these guys being red, but we have blank space above the bids, above the current market price, and blank space below these offers at the current market price. If you're getting in at these levels, you're just market buying, because if you want to buy 5 cents above the current market price, you just get in at a market order at that point. There's no reason I would see for anyone to buy 5 cents above market price, because you're overpaying for that asset drastically. If you want to get in on market, you start lifting offers. So let's go ahead and take a look at what that looks like. So again, the price ladder, in this example, we have the S&P. This is an older example, so the S&P is not trading 27.27 right now. It's at the 33.38 quarter to be exact. And this is a older example, so let's just use what we got here. So what is the current market price? As identified before, we have the current market price sitting at these 27 3 quarters, correct? And it's highlighted right here for everyone to see a little better. 40 of these guys right here sitting want to sell at the 27.28, but there's 0 that want to buy them. So in order for these 40 to actually fill at this level at 28, we have to have interest right here at the 28 on the bid side, right? But as you can see, where are the closest bids? If you want to actually buy at market, you click this blank area nearest to the offer price, right? So you're lifting offers at that point. Assuming that no new orders come into this area, either part of the 40 drop down into the 27 3 quarters or 0.75. Some of these guys could probably drop down and sell for less, or part of these 9 right here have to move up and pay more, or maybe some of these 48 decide, hey, you know what, it's time to move up into this offer area and start paying more. So you can see this is an example. Maybe five of these guys from the 9 over here jump up and want to pay more, or maybe some market buyers come in, 5 of them from a different level and want to pay more. So in this case, the market quote would be 9 bid at 27 3 quarter, or 40 offer at 27.28. That is the current market price at this point. This is the actual market price I just said, and last contract traded is actually now volume. So markets move, as we said before, if buyers are willing to pay more, so the markets will go up, or sellers are willing to receive less, markets go down. Which is a critical concept, and more buyers than sellers market goes up, more sellers than buyers market goes down. Pretty simple in that regard. So when does a contract actually trade? One contract will trade when the buyers pay more to meet the current best offer. So if they're sitting here and no one wants to move anywhere, markets will probably stay stagnant, right? These guys at the 9s have to either move up, or the 40s have to move down to accept some of these offers or bids. However, if the 9 move up and only 9 out of these 40 get eaten up, there's not enough room to push them higher unless more and more bids come in and start eating up some of these offers. So sellers accept a lower price to meet the current best bid. That's what another contract will trade. So how do you place your trade? So it depends. Do you want to get in at market, or do you want to wait for better levels? If you're waiting for better levels, you might be waiting a little longer. And naturally, if you're getting in at market price, you'll be getting in right away rather than a limit price. If you're sitting down here, let's say, for example, at these 27 quarters, if you put in another one, that becomes 41, and price might just shoot up without you, rather than getting in at market and lifting an offer right here and getting along with that market move. So again, it really depends on how you place a trade and what the strategy will be at that point. So if we introduce the footprint here, guys, the footprint is a reversal bar chart. We're going to look at it in a little more depth, but it shows the bids by offers traded at a market level, and it highlights sell and buy imbalances. Now, a critical point here, As to why the buy imbalances show up on the actual offer side or on the right-hand side and why the sell imbalances show up on the left-hand side or the bid side, this is market buying on the offer side. Because remember what has to happen on the offer side, right? You have to lift an offer. So this is a crudely drawn drawing of the DOM. So this, if this is the offer side and this the bid side, for an offer to get traded right here, what has to happen? You have to lift an offer or actually trade that offer to get in on the buy side, right? So that's why we have highlighted buy imbalances on the right and highlighted sell imbalance on the left. The same thing goes for here. You have to start hitting bids if you want to get in at the market. So this shows a bid by offer traded at market level. So again, if we grab this as an example, this high tick right here at these 40 halves, let's call them, I think that's a level, we have 91 by 452, right? That means 91 bids traded here and 452 offers traded at this level, right? So that means you got some stuck longs at this top right here as we have a unfinished business area because we didn't get a 0 by a number print. So that means a few unlucky people got stuck at the top and ended up buying a high tick before it started to reverse, right? So the footprint is what we see at actual market traded, not interest. The interest is on the DOM or the inventory. Another key concept here is these blue boxes and red boxes actually are translated from the DOM on Sierra charts and reflect orders, a threshold that I personally chose of 599 and over. So if we have 599 on the bid or offer side, that will get highlighted in these blue and red boxes translated on the footprint. So you can see interest in the market. You see how these offers start moving up at this point and these bids actually start moving up slightly. That interest pushes the market price higher. Once the offers start stagnating and the bids kind of capitulate here after they've moved up, offers actually start dropping, you get some bids starting to get eaten up, and then the auction kind of neutralizes itself yet again. Oops. So again, with the footprint, it's used for directional confirmation. You want to see more buyers and sellers. In this example, we'll show you just shortly, but what does that mean based on an imbalance level? So the imbalance level is also based on a threshold, so 500 times the diagonal. Let's take a look at that when we see this picture. It identifies strong buyers and sellers based on the imbalance and is best used with market structure. So we're going to look at We've seen market structure last lesson, and you have to look at market structure in conjunction with the footprint to identify key levels of support and resistance for potential entries, exits, and following directional movement. So this micro view on the 5-tick reversal, and again, what do the imbalances tell you? The imbalances tell you strong market selling at certain levels, right? And if you follow the directional movement of all these market sellers really coming in towards the top of these red candles and slowly trying to push price lower, with the interest right here, again, the bids and the offers, the interest showing downside pressure. This is a very critical concept that a lot of traders miss. And again, these lines, this blue line right here, horizontal line, is based on the market structure longer term resistance point. So after breaking it, you get pullback potentials, and in these areas, strong sellers come in. So the idea behind this is if strong sellers come into the market based on sell imbalances, you want these levels to hold. So every time a strong seller comes in, wipes out a buy imbalance, that means there is more directional movement to the downside. And as long as these sellers continue pressing price lower and not getting retested, look, strong seller comes in and not getting eaten up, then the market price has the opportunity to go down further. That means more market selling is actually coming into the market. So right here you get a stack of buy imbalances, but that's not really to worry because when that reversal happens, these guys get eaten up and then they drop and these sell imbalances actually eat up whatever strong market buying is coming into the market at this point, with these bids pulling price lower and offers pushing price lower. So as offers drop, that means the interest in selling gets stronger towards market levels, pushing price down. And as these bids run away, that means buyers are getting pressed lower, pressing market price to the downside. The interest incrementally drops in a step ladder fashion on both of them, seen very interestingly on a heat map. Now again, strong selling coming in, market selling, market selling. Some market buyers try and support price, market sellers take them through, and then at a certain point it capitulates. These bids are not scared anymore. They really want to hold their ground, and then market buying comes in at a key support structure. So this is a 5-tick reversal, seeing more on a micro view based on just the footprint chart right here. But we also have a larger view on a 10 tick. The higher you go on a tick chart, the more macro, quote unquote, you see the market. So this is the market based on the 10 tick right here. You can see a lot less movement, but it shows you where the strong sellers come into the market and where they're expected to hold. Just because you have less levels here and less imbalances, that makes these sellers and these levels a lot stronger because they're on a larger view. So if we base entries and exits on order flow, we will do our analysis first on the market structure to identify the key support resistance levels, and then at TRADEPRO Academy, really love the footprint for entries and exits. So we manage the trade with the DOM and inventory, then we start exiting with both. So let's take a look at what that looks like quickly before we kind of wrap this really short lesson up. Now, if we take a look at, before we wrap it up, I'll give you an example based on the market structure and the footprint alike. So if we look at this right here, we look at the sell imbalances. If we're assuming that the trend is to the downside, we look at the sell imbalances as last chance levels for the sellers to really come in and press the market lower. So that means we're looking to enter around sell imbalances because these are strong levels at which the sellers are intending to hold price if they come back in. Because these sell imbalances mean strong market selling is coming into the market. Now, if we grab this example right here, and we get this spill and we have our resistance level, we want our resistance level to break, so we're waiting for a break of that resistance level. We're looking for a pullback into some of these strong sellers, sell imbalances, to continue to push price lower. So if we're looking for entries somewhere along this line, with the intention of our stop being above some of these market sellers, we have a really good chance to enter at a pretty low risk area based on some of these sell imbalances for a continued move to the downside. Even if you miss this move, you're just trying to capture some of these sell imbalances or place an entry maybe 1 or 2 ticks below some of these sell imbalances with a stop above these strong levels to continue capturing the move to the downside. Because what happens is, especially when you get a double stack like this, so 2 sell imbalances one on top of the other, that means these guys are strong market sellers and they're going to start covering if price continues to and through that level. So if we get a solid break above some of these strong sell imbalances up through them, that means these guys are in trouble. These market sellers are in trouble and they're going to start covering. And what do these market sellers turn into after they've entered the market? They're buyers. They're buying either to take profit or buying at a stop loss. So once they get cleared, if price moves higher and above that level, these guys, strong market sellers, these guys right here are going to start buying, buying to cover, buying to cover, buying to cover. And that strong buying turns into buy imbalances and a continued move to the upside. So the idea behind all of this is setting limits based on these strong sellers after you've done your market structure analysis to capture a move to the continued downside, with the idea that these market sellers on the retest of their levels are really going to hold this price, and if they don't, you've got a huge buy stop run above. So let's take a look at what that really looks like here on one of the charts. If we grab, let me see. If we grab both market structure and buying and selling, we have a great example based on yesterday's price action, on Friday's price action. So let me go ahead and pull that up for you guys. Let me see, where is that level? 42. All right. So based on this example from yesterday, you can see where the market actually opened here. Oh, that's a bit fat. Where the market actually opened somewhere in this area around these 57s or so on the S&P 500. And we've got a continued move based on structure to the downside, breaking through all of our resistance all of our support levels and holding them resistance. So this is a first area of interest. After we break through this key support structure, we retest that support structure, holding it resistance right here at these 54s. Now you can see market structure rotation at this area, and if we're looking for entries based on the footprint, we can go ahead and find that level here on the footprint, and we're looking for sell imbalances to hold. First, we're looking for sell imbalances that took this price through that support structure, and we're looking for the sell imbalances to hold at these 54s, 55s at that area. So this is what price looks like here on the footprint. After we've done our market structure analysis, we get the break through our level right here. We get the break, and what happens is strong selling actually comes into the market. You can see this huge stack of sell imbalances right around these 54s. So our idea is, okay, so we're going to see on the retest of this level if we can get some rotations, and this huge stack, you look at that, that's, what is that, 1, 2, 3, 4, so a quadruple stack of sell imbalance becomes a massive level of resistance and a good entry area for the continued move lower. Because what happens if these guys get flushed and pushed to the upside? Market buying ensues because they start covering their position. We're probably going to rally at that point. So if we go ahead and move this chart, you can see we get the rotation back up. It clears some of them, but not really, because it starts to wick at this area, so a slight little head fake at that point. The key is not to buy right away this first sell imbalance area. Let it rotate back into your level and present you with rotations and some more sell interest coming at that level. Because if we pop this and hold it as support, this thing's going to pop up. There's no confirmation, right? So we get a pretty decent clearance of that level, and then you can see sellers start to come in incrementally. You can see sell imbalances right here. So if you're looking for entries, maybe 54 quarter to half at this point based on these sellers and these market sellers here, with a stop somewhere above in this area. So let's see what that looks like. You get a strong stack of sell imbalances. You get a fill at this point. Sell imbalances come in on these rotations, and then you get the spill to the downside based on a lot of these market sellers through that support zone and continuous movement to the downside. Again, if you're looking for potential retraces back into these triple stacks, back into this area, if price manages to get there. If it doesn't, it doesn't, and it leaves without us, right? So you get an incremental touch of one of these sell imbalances right here, somewhere in this stack, so that could be a decent opportunity. More sellers come in, you get multiple chances, and then price continues to move down through these support levels, holding a lot of these market sellers in terms of these sell imbalances. So again, we're going to start with the market structure based on these tick range charts to identify how markets move based on price action, and then we're confirming with the footprint. So based on entries and exits, that's all we had today. The whole exit component comes in the next lesson, but the basis of it is that we're looking for, if you're already in a trade, you're starting to identify areas where potential sellers might start capitulating, which might mean some of these buy imbalances, some of these buyers start coming in, or you're coming into the next support zone and some buyers really come in and step in on that area, or you have an inventory level that's right below that price and you see a buyer come in, and these inventory levels don't move either to the downside, but they start moving to the upside. So that's a key exit area at that point. Now, in terms of next lesson, this is all I had planned for everyone today. I hope everyone really enjoyed this. If you guys want to know a more in-depth and longer version of a free order flow day trading course, drop down into the link below and check that out. It's really extensive. It has a lot more order flow tools in it that we use on a daily basis to trade. If you guys want to sign up for a super amazing, I don't know how many more adjectives I need to use, but a great deal, a great TradePro deal, once in a lifetime opportunity. On lesson 6, we're going to be offering this only to those who watch live. Sign up for the free day trading course down below, and you guys will get a special offer. So sign up for that course, get a special offer, and we will see everyone tomorrow for day trading the free day trading course for beginners, lesson 5 out of 6. So in next lesson, I really hope you guys are there because it's going to be amazing. We're going to go from front to back with our day trading strategy that we use on a daily basis. So we're going to expose our favorite day trading strategy, one that I use consistently on a daily basis to generate high probability trades. So don't miss that out. This is Victoria from TradePro Academy, and I hope you guys enjoyed this lesson. Take care, everyone. And if you guys have any questions, don't hesitate to email us.